Okay, good morning. Today we are going to discuss about the topic on determination of forward and future prices. This is an important topic related to the financial derivative, especially for students of MBA finance. Now we know that forward and futures are the two very basic type of derivative, and determining these prices is an important topic that we have to. So today we are going to discuss how we derive the prices of forward and future. Now, when we have to find out the prices of forward and future, what we need to understand is that we need to find out the difference between the investment assets and the consumption assets. So assets has to be classified into two ways. Investment assets basically are those assets which is held for investment purpose by at least some traders. An example of this includes your stocks, bonds, gold and silver. These are some of the examples. But when we talk about consumption asset, these are those assets which we primarily use for consumption. Example can be copper, crude oil, corn, etc. And many types of commodities will come under this consumption assets. Now, when we determine these future prices and forward prices, there are certain assumptions that we have to be noted. And first assumption is that the traders are subject to no transaction cost. This is not a very reasonable assumption, but still then to derive the prices, we have to have this assumption there is no transaction costs, even though all transaction requires there is some cost associated with all the transactions. And next assumption is that all traders are having the same tax rate, which is also not a very reasonable assumption, but still then to arrive the future prices we have to have this assumption. The third assumption is all about the risk-free rate of interest. As we all know, risk-free rate of interest is the particular rate of interest which anybody can borrow and anybody can lend at this particular rate of interest. This is another assumption. And the last assumption is, and very important assumption, is called as arbitrage opportunity. So when we say arbitrage opportunities, it simply means the opportunity which the traders has, especially when there are when there are price differences in two different markets. So this is the very basis of future prices. So arbitrage argument is the basis for determining the future prices and the forward prices. Now these are some of the notation that will do, say S naught to note the price of the asset underlying the forward or the futures contract, then S naught, then F naught is the future of the forward prices, and T stands for the time until delivery rate, and R is the risk-free interest rate of rate for maturity. Right. So with this four notation, we are going to derive the future prices. So the first thing, let us find out how to find out the forward prices of investment assets. What sort of investment asset? Those assets which does not give a dividend or a coupon, neither dividend nor coupon. Example, we can cite many examples. Those company shares which usually do not give a cash dividend, rather we call them as those investment assets which are non-dividend paying stock, or a coupon, or a bond. Bond, there are very many types of bonds, but zero coupon is just bond where we do not pay at that annual interest. Technically, we call them as zero coupon bond. This is also called as deep discount bond. Now, this is the formula how we observe. So when we say, I'll just derive, take the note of this. So when we say, right, the forward price, right? So usually as per the time value, what we understand is that SO 1 plus R to the power T. So this particular portion, this is your compounding factor, right? So this is the very basis of using what do you call it, determining the future prices. So when we go down further, So when R is compounded continuously, this would be changed to a new formula, simply like this. It would be changed as FO is equal to SO 1 plus RT. Then this would be simply, it will be replaced with ERT. So this one we call it as when it is compounding continuously. So this is the very basis of how we derive the formula for forward prices. So as we see equation, now this particular equation is also applicable to any investment that provides no income and has no storage costs. Now let us determine the price of a forward prices. In this particular example, what are we given? We are given this information, right? Let me just write it down. So we have to find it out. What's the price of forward prices? Given the price of SO is equal to rupees 40, then what is the risk-free rate of interest? Risk-free rate of interest is given as 5% per annum, and what is the time? Time to is given is 3 months. So 3 months basically we express in terms of 3 by 12. So with this we are going to work out. So how we work out is, so let's see. So as that is SO, so we already have FO is equal to that is future price. Now we need to just replace this particular values and we can easily find it out. So here SO is 40, right? Then E is the constant E, R is your 3 by, it's a 5%, 5% means 0.05 and T is 3 by 12. So when we work out, so what basically we find is 40 rupees 40.5. Now this 40.5 is called as the forward pricing, and this is an no arbitrage price, we call it out. This is also called as at par price. Now what is more important now is that what would be the situation if any forward price is not this. So ideally the forward price with the given conditions, we all know that this is SERT. So in a situation when FO is not equal with SOERT, then we have an opportunity called as arbitrage opportunity. So arbitrage opportunity, as we have already told you, right, as we have already understand, it is all about getting the risk-less profits by taking the advantage of difference in prices in two different markets. Now let's see, suppose we can have a situations where this is left hand side, this is right hand side. Now if there is any difference in this price, for example FO is greater than your SOERT, or for that matter, or SOERT then FO. So case 1 and case 2, in both the cases will have an arbitrage opportunity, and let's find it out what is the payoff to the particular trader. Now let's see the first case 1. So earlier we already knew that given the price of spot price of rupees 40, and when R is equal to 5% and T is equal to it is for 3 months, right? We found out that FO is equal to rupees 40.5. So here, so that means it is saying that FO is now given, we have rupees 43. So in this case, this left hand side is greater than your right hand side. In other words, what we understand is that the forward price is costlier as compared with the spot price. So what will you do in an arbitrage? We'll buy from that market which is cheaper and we'll sell it out in the market where it is costlier. So in this particular case, spot price is cheaper, so we have to buy from the spot price and we have to sell it out to the forward market. So let's see with this example. Now certain actions we have to do. The first thing what we need to do is that we need rupees 40 to buy this particular stock. So in order to able to buy this rupees 40, what we need to do from this spot market, we have to borrow rupees 40 from a bank, and as we have already assumed, we can borrow at a particular risk-free rate of interest. In this case, it is 5%. So we borrow this rupees 40 from a bank, right? And by borrowing this rupees 40, what we do is that we buy from that market which is cheaper, in this case the spot market. So we have a stock with us. Now this stock has to be sold out in the market where it is costlier. So the costlier market is where? It's a future market or the forward market. So now in order to assure ourselves, we have to have a contract. What sort of contract? We can do a short forward contract. Short forward contract, as we already know, is all about you are assuring yourself that you have a right to sell at the time of maturity. In this case, at the end of 3 months, we would be able to sell this particular stock at the particular price, in this case 43 rupees. So let's see, when at the end of 3 months, what are the things that we have? So at the end of the 3 months, what we have is that because of the short forward, that means we have a right to sell. So we sold it out and we have delivered the stock, right? Then by selling the stock, what we received rupees 43. So now then the loan that we borrow at the rate of the loan which we borrow, it was rupees 40, but this we had to pay a certain rate of interest, 5% rate of interest, compound that, continuously compound that. So what we found is that your rupees 40 that you borrow, so when it is compounded, you are getting as rupees 40.5. So right, so this portion is your continuous compounding, that is 50 paise. So then when we have done that, we have certain profit. And what is the profit? The profit is simply rupees 43 in which you did your sales, and then rupees 40.5. So this difference of rupees 22.5 is your profit. So in this condition, what we have derived is that if it is not at par price, there is an arbitrage opportunity, and in this case this particular trader is able to earn a price of rupees 2.5 out of this contract. Now let us see another conditions. What would be the case? In the previous case, we had forward price was more than spot price, but what would be the case? What would be the situation if spot price is more than forward price? Now in this situation also, as I have told you, the trader still can have an arbitrage advantage. Let's see it out, right? Okay, the first method that we just adopted is called as cash and carry arbitrage, for the very reason that we borrow cash and then we carry the stock for 3 months. That is why it's called as cash and then carry the stock, that's why it's called as cash and carry arbitrage. Now next example, the cash 2. So this is the case of this particular case where your spot price is more than your forward or the future price. So here they have given the price is rupees 39 rupees. Forward price is rupees 39. So this is a case of case number 2 where your spot price is more than your forward price. In this case also we can earn an arbitrage profit. Let's work it out. So here first thing we have to do is that we have to do short sell the stock. Short selling means you do not own the stock, but rather you borrow and sell it out because you have the opportunity to sell it at a higher price. So rupees 40 you are selling it out, right? Now the sell proceed rupees 40, now you are investing for 3 months, because the maturity period for this forward price is for 3 months. So you invest 40, so you would be able to earn interest of 5% continuously compounded for 3 months. Then you also do a forward contract, a long forward contract. So long forward contract, basically, as you have already know, it's all about a contract in which you have a right to buy this particular stock. All right, let's see what's the consequence at the end of the 3 months. So at the end of the 3 months, you buy the stock for rupees 39, right? Forward price. How are you able to buy this one? You are able to buy this one because of the long forward contract you already had. So you already had a long forward contract, so you are able to buy at the price of rupees 35. Now, the short selling, now you can close it out. We call it technically is a square off, and whatever you borrow the particular stock, you have given them you return back to the lender. Now, what do? The investment that you had for rupees 40, now when it is compounded, you are receiving rupees 40.5 at the end of 3 months. So in this case also, we have an arbitrage profit. And what is the arbitrage profit? Arbitrage profit is, in this case, 40.5 is the amount of money that we receive, whereas our cash outflow is almost rupees 39 only. So in this case also, we end up earning a profit of rupees 1.5. So basically, from this example, we can generalize, and this particular arbitrage method is called as reverse cash and carry arbitrage. And now from this, we can generalize, as I've said, we can establish the relationship between the spot price and the forward price. So for any investment asset which does not pay any dividend, or for zero coupon bond, the formula is forward price equal to spot price, then continuously the compounding factor, in this case continuously compounding factor, right? Then if forward price is more than your spot price, arbitrager can buy the assets and short forward the contract on the assets. And in the other case, if forward price is less than your spot price, in this case also you can earn an arbitrage profit, but what you have to do is that you have to short the asset, right, and enter into a long forward contract on it. So from this, we have understood how to determine the price of the forward and the futures given the spot prices, the rate of interest, and the time of maturity. Now we can further extend how to derive the particular forward price for other asset, which gives you the cash income also. When we basically say cash income, means when you have a stock, you are entitled to receive dividend. So this dividend is called as your cash income. Or in other case, we also have bond, which is coupon bearing bond. So coupons are also in the form of cash income. So in those cases, we have to change the formula from the earlier formula of FO. Okay, all right. Forward price equal to ERT. Right, this is for, I put it 1. Now we have we can derive the second formula. So your spot price, then whatever the cash income you receive, then we do continuous compounding with the given maturity and the particular rate of interest. So this is the particular formula. But this I has to be expressed in terms of present value. That means, so you have a TO and T1 and then say T2. So your contract is from here to here, but at T1 you are receiving an investment, okay, a cash income, an income. So it's represented by I. So but this I we have to convert here. What is present value of this particular I. So that is the only difference that we have to do. So let's see it out. Now here is an example. What's the requirement? We need to find out the forward price of a particular underlying, and underlying is a bond whose current price is rupees 900 and the contract is maturing 9 months. At the same time, this coupon, this bond is giving you a coupon payment of rupees 40, which we have to. This one is called as cash income, and with this we are going to receive in 4 months time. So this would be in the 4 months time we are going to receive at what, how much we have to receive. We are receiving here rupees 40, but this rupees 40 we have to find out the present value at the time TO, right? And then R is your 4%. So let's see out. Okay, so we have this information. That is, we have forward price equal to ERT. So we need to find what is the value of SO. Here it's rupees 900. Then R is your, that is given for, if I am not mistaken, is 4%. Yeah, it's 4%. That is 0.04. Then T is for 9 months, right? 9 months basically when you express in terms of year, it has to be like this. Now question is, what with the value of I? I we have to work out like this. I value is 40, but we have to express in terms of present value, but we have to do like this. So this, the value would be 39.4. So let's see it out. So 900 is your spot price, R is 4%, T is 9 by 12, that is for 9 months. Then I is, as I told you, we have to convert into present value. So we have the value as rupees 39.6. So that means at TO, T1 and T2, so rupees 40 that we receive, the value is now 39.6. So this much we have done. Now let's see it out. So then easily we can find out the value of forward price. The price is now 886.6. Now this 886.6 is what we call as the forward price, and this is the no arbitrage price. So the forward price has to be rupees 886.6. If it is more than or less than this, you still have an advantage. You still have an opportunity to the trader, and that opportunity we call them as arbitrage opportunity. Okay. So here also the same example we can find out. Case 1 we can see when the forward price is less than your spot price, and your the case 2 we can see when your forward price is more than your spot price. So example, it was supposed, so here is given, it was if it is at par price, the price is supposed to be 886, right? But 0.6, but in this case we are given, the forward price as rupees, 920. Okay, so this is a case of forward price is more than your spot price, right? More than your spot price. So let's see out what is the advantage and a trader can earn from this. So same thing in the previous, for those assets which does not have a coupon, who does not pay any coupon, or for those stock which does not pay any cash dividend, we had two actions, action today and the action at the time of maturity. But in this case we are going to have three sort of actions: action today, and the action that we are going to action today at T0, and action at T1, and action at the time of maturity. So now let's see action today. What we need to do here, same thing, cash and carry model. So we'll borrow rupees 900 from a bank, but how we do is that this 900 will just apportion into two. The first portion would be this 39.6. This will borrow for 4 months, right? Because here we are going to get it rupees 40, right? So this 39.6 will invest for 4 months, so that at the end of 4 months we get this rupees 40, and then the 860.4 will invest for 9 months, and then we'll buy the stock. And then what we'll do again, short forward contract for 9 months at the price of rupees 920. Then what things we need to do at in 4 months time? So we'll receive rupees 40 income on the assets, and then with this rupees 40 we can pay back the first portion of the loan, that is 39.6 with interest, right? Then at the end of the 9 months, what we can do is that we'll sell it out, the assets, at rupees 920. How are we able to sell it out? Because we already have a short forward contract for 9 months at the rate of rupees 920, so we are able to sell it at this price because of the forward contract that we have done. Now we can use the second part of the amount, that is rupees 886.6, to repay the second loan which we had borrowed for 9 months. So 860.4 for 9 months with continuous compounding interest rate of 4%, we have to pay 986.6. So the profit realized is rupees 920 minus 886.6. So ultimately we end up rupees 33.4. So what from here what we can arrive is that the price has to be no arbitrage price or at par price. Otherwise, in any difference in the price of forward and the spot price, the trader can take the advantage, provided the market is efficient, of course, and arbitrage advantage, and he can earn a particular profit. So same thing we can find it out in the cash too. When we can simply change this one in cash. This one also we can still arrive then arbitrage profit. I'll go a bit faster because it's quite similar with the first problem that we, in this case also, reverse cash and carry model. You short the bond for rupees 900, you invest that one by apportioning again to. In the previous case, when forward price was more than spot price, what we did was we borrow, right, in 2 portions. For 4 months and for 9 months. In this case, as we have shorted the asset already, we have 900 rupees with us. This 900 we can use for investment purpose, and we are apportioning into 2. The first part, rupees 39.6 and rupees 160.4 for 9 months, and then we have to go for long forward contracts for 9 months, so that we can buy the asset and pay back the asset which we have done for short selling. In this case is the bond. Right, so in 4 months time we'll receive rupees 40. This rupees 40 is nothing. It is arrived from the investment that we did from 39.6 in 4 months time at the rate of 4% per annum continuously compounded. We get rupees 40, right? So this rupees 40 we pay to the particular lender. Then in 9 months time, what we'll do is that we receive rupees 186.6. So from where we do receive this, we receive this one from the second investment portion, which was rupees 860.4, right, for 9 months. So we have this, and then out of this rupees money that we receive, then we can buy the assets, and we are able to buy this because we already have a long forward contract for rupees 860, right? So 860 we are able to buy. Now we close out the short position, the asset we have, we pay back to the lender. So here also ultimately we realize a profit of rupees 886.6 minus 860. So we end up with rupees 26.6. So this is the case where we bought the profit in case forward price is more than spot price, or even in those cases where forward price is less than spot price. This thing we can extend for other investment where you are given non-yield, right? So we will not elaborate. The same calculation we can use, the same argument, that is arbitrage, right? The next thing, without taking much time, we can just elaborate upon. We now know how to determine the forward price and the future price given the value of the parameters like the spot price, the rate of interest, the time to maturity, what is the likely income that you're going to get. Now issue is, given a chance, should we go for forward or should we go for the future? The answer lies in certain factors, and one among those factors is the very important factor is what is the correlation between the asset price, that is the underlying, and the interest rate. Okay, so based on this we'll decide whether to go for a forward price or a future price. Then other factors that determine is customization and standardization. If you want to go for customization, obviously it has to be forward. If you go for standardization, you can go for futures contract, which is you can easily find the terms and conditions in a future exchange. And then transaction cost is also another factor that determine then default risks, the chances of being default, right? What is the chances of being default in a forward, and what is the chances of defaulting being in a futures. Futures being an exchange traded instrument, there's a late chance of default. These are some of the factors, but more importantly, the first factor in the two slides I'll just elaborate. Okay, correlation between the asset and interest rate is one of the most important factor that decide whether to go for the future price or the forward price. So let's see when there's a positive correlation between the asset price and the interest rate, and thinking that we are a long position holder. So when asset prices rise, your interest rate also rises. So in that case, if you are a future, right? Similarly, when asset prices fall down, interest rates also fall down. Now you just assume yourself as a future long position holder. As a long position holder, what happened? What you have to do, as we all know, the future in a future instrument, there is something called as mark to market margin, whereby settlement is done on everyday basis. So if asset prices rises, you as a buyer, you are benefiting, right? So you can withdraw the margin out of the mark to margin, and this excess amount, what you can do, you can invest in a higher rate of interest, because interest rate is also going up. But in case if assets are falling down, you are losing. So as per the mark to margin, you have to bring in more money, so you have to deposit this margin. So this deposit you borrow at a lower rate of interest. So this is the case when you have positive correlation. In this case, it seems as a long position holder, future is more beneficial, because when you have to withdraw, when you have excess money, you have an opportunity to invest at a higher rate of interest. And contrarily, when assets are falling down, interest also falling down. When you have to bring money, but you can borrow at a lower rate of interest. Now, what would be the condition? Okay, what would be the condition if there is a negative correlation? Means when asset prices rises, interest rate falls down. When asset prices fall down, the interest rate rises up. In this case, it's not beneficial, because when asset prices are rising, you have excess amount coming in, but you cannot invest at a higher rate of interest, but you have to invest at a lower rate of interest. So it's not benefiting. Similar is the case with when your assets are falling down, you have to bring in more money, deposit your margin, but you have to borrow. You end up borrowing at a higher rate of interest. So in this case, our recommendation is not a future, so we have to remove, but rather forward is, because here we don't have to bring in any margin. So last slide. So from this summary table, what we can see is that if you are having a long position holder, and if there is a positive correlation between the assets and the interest rate, it's well beneficial to go for the futures if you are a long position holder. If there is a negative correlation, it's better to go for the forward. And if you see from the short position holder context, so it has to be it's a trade-off. I mean, like it's mutually exclusive. So short position holder, when you have a positive correlation, you better to go for the forward, and for negative correlation, it's better to go for the futures. So here's the end of my class. So basically, the purpose of today's class is especially how to determine the prices of futures and forward. Thank you.